Hey everybody, welcome back. We have a ton of topics that we're going to cover today, from how to use day trading probabilities to make them swing trades and long-term trades, how to use the current data that's out there, why tech is on a tear, why it's probably going to continue after this week's data, specifically after retail sales. And then, of course, you have the talks of war de-escalation this weekend. So let's just get to it. And there's going to be a lot in here. There's parts you're going to want to probably watch a couple times, but let's just deal with the basics. If we just take a look at the ES, the futures market, we can see this support level was completely held, tested 1, 2, 3, 4 times, and then we enveloped on Thursday the 8th. And then since then, we've just been grinding, working off that gap down, lifting. The easiest way to always mark this stuff is just to drop a VWAP from what? The peak. And you'll see me use this strategy in day trades and swing trades. I'm going to walk through that in detail today, specifically because I get asked a lot about, I don't day trade, I just do swing trades and long-term trades, and I'll show you how to implement those strategies and roll them over. But what's going on out there is pretty important. So what we're going to do is drop this to a week, and then we're going to look at this and clean it all off. And this is not always what happens, but it's usually what happens. When you get a hammer like this, you have the red bar and then you get the hammer. What you get is a slingshot. So if you picture a slingshot and you picture pulling this back, you tend to get the equal and opposite reaction of this. These patterns are very simple patterns that are called morning stars or evening stars. If this was a shooting star from on top pointing down and this was green, it'd be an evening star. This is a pretty classic morning star position. You can go and look it up. But what it's doing is it just pulls, snaps back, and the measured move is what? Just to the top of there. From that, and it's going to tell you exactly what you need to do. And now you're going to see if you're going to flip that and what you're going to do. I think I'd be remiss in not just pointing out something that's pretty comical at this point. That if you look at that close, you have the third best all-time close on the weekly ES, which is kind of funny considering how crazy we've been about it. But there's a lot of data that we're going to get into today on not only the technicals, but macro, what's going on under the hood, and how people were just dead off on this. And I'm going to preface this. Nobody would have gotten all these things right. Nobody would have looked at this and gotten all these things right that actually got us to where they are. So for a lot of people out there, they missed this and they missed a chunk of it. It is what it is. You just move on. And again, I want to preface that. And I can walk through the probabilities of people actually being able to predict PPI, CPI, retail sales, and de-escalation of war, on top of the fact that you were also going to predict that the U.S. yen was not going to be as big of an issue as we thought. So I wish you the best if that's your strategy, but it's a fool's errand. So if you take a look here and you can see how you're holding that trend line, I think it's really good. But once again, you flipped and you have the measured move. For us, looking at something as simplistic as RSI, I usually do not leave the moving average in, but people seem to like it. I do think it's important to note something here. If we go back, and for this part, I'm going to just take it out, pop it out real quick. If we go back and just look at the measured move and say to ourselves, okay, this is where we were in November. This is where we were in April. This is where we are now. When I show you some of these documents today and some of this research, it's going to be, in my opinion, pretty eye-opening for how bad this got across the world and how fast it got across the world. But what we're noting more than anything is we're seeing this, and we're seeing tech rally. And the question is, what this snapback in particular, what's so powerful about this? And then what is this telling us about going forward? Because this is something that you don't see every day, where you just have 3 weeks of just sheer dumping. And then all of a sudden people saying, you know what, we might be wrong. And then people saying, you know what, we really are wrong. And what happened with this is it broadened out, and it actually triggered something that you don't see very often. So let's just jump right into it. Now in front of us is the XLK, or technology sector. Top 3 names in here would be very simple. It would just very simply be, you'd have your Apple, you would have your Microsoft, NVIDIA, not in that order, but they're your top 3 names that make this up, and they make about 50% of it. I would go through the holdings here, and I think that that's important to do. So when you look at these sectors, one of the things to always gain from this is go, okay, well, what does this tell me? Go through the sector. I have a list of all the sectors, all the holdings in every single sector so that I can go through them. especially when I start to look at things like this, which I think are pretty important. What we saw was a massive change the other day, and it was a change that we usually don't see. And it's significant. And I'll explain how this affected XLK, and then we can talk about how it affected the overall market, and we can see the breadth changes in the market, which we'll go over in a little bit. But again, XLK right here, and this is going to determine the breadth. I want you to think of breadth as advanced decline. And is the breadth expanding or is it declining, right? It's always doing something. It's never stagnant. It's always going one way or another. But this tells us very clearly that we were declining at a rapid pace. And then out of nowhere, we reversed. One of the things you'll note very simply in any video that was done by me over the past week from the 5th to where you were on Thursday changed drastically. And the reason for that is because all the data changed. You had 4 core pieces of data that were supposed to be really bad. Everything from war, PPI, CPI, retail sales, recession increases. We had people calling for 150 basis points in cuts. Bitcoin plummeting. Like, we had a lot going on in a very short period of time. And we're not even talking about the escalation of what's happening in Ukraine and is Iran going to attack? Are they not? A lot happened. And for us to look at what happened, and the easiest way to say this is it all went our way. It all went positively, at least for now. And we can address that a little bit. But let's look at the technical aspects of what happened. We went from a breadth of 10 to a breadth of 90. Now, this happened in less than 10 days. All these breadth thrusts that you constantly are hearing about, and this is one of them, and it's only fired in a very short period of time. This particular one, the way it's set up, is only fired, I think, since 1955, 17 times. And this happened within 5 sessions. The rate in which this happened was literally an about face. And this caught a lot of people off guard. Now, I'm always one of those people that look for institutional support because it's how I trade, and I want to be the person that's buying what institutions are buying. I don't want to buy what retail buys because retail's fickle and they change their name. I'm looking for longer term trends. Even on the day trades, I want to know I have institutional support behind me. So what we're seeing is this massive change. But note here, and then note here, and then note the breadth here versus here. This is telling you that the breadth expanded greatly, and it came to a level where this moved so fast in 5 sessions, you went from a breadth on a 10-day average from 10% to 90%, which is absolutely huge. 1955, when they combine this together, since 1955, you're looking at 17 times that this happened. Let me show you the data. Now, one of the core things people are going to say when they look at this is, well, you didn't really have XLK or the same names back then. It doesn't matter. What you're charting is human behavior. And that's what all this is doing. This is why breadth, or RSI, to me is so significant. Really breadth, but the RSI too with the magnitude, because you're charting human behavior. Humans haven't changed, right? It's fear and greed. That's all it is. Now, if you look here in 53, I get it. We didn't know what a computer was, right? But let's say it was a buggy whip. It doesn't matter. It's human behavior. And when you change that human behavior, this is what happens. You can agree or not agree, but I have not seen human behavior change in 25 years of trading. It's always they want to buy the fear, right? And they want to sell the greed, but they never do that, do they? They do the exact opposite. They buy the greed and they sell the fear. Even though they know what they want to do, they do the opposite. So then what happens is when it flim-flams really hard when they're wrong, okay? And you can see that we have a mark right here. Let's look at this data now. And again, this is specifically for technology. It has nothing to do with the New York Stock Exchange or the NASDAQ, which have not triggered this signal. And that signal is obviously a little bit harder, in my opinion, because it's an entire index. But I did think this was pretty interesting. So here is 12 months later, and we can go through the week, the month, 2 months, 3 months. What I would do is just go, okay, well, you had this period in time where this didn't matter at all. And that was really 1979, 1980. And if you take that into account, well, what happened during here? We had inflation that was through the roof. Right? People had 18% mortgages. It was absolutely insane. People that know that or look at history, that you can go back and look at where the 10-year was during that period of time. But you don't have to take it out. You should blend it together. But you should understand why this looked the way that it did. You had massive inflation during this part. Now, if you look at the rest of this time, specifically even just take the last 2, you could take this one. But, you know, right there, what did we have? We had $1.7 trillion being invested in the market. No matter what you bought, it went up. People were buying JPEGs and calling them NFTs, thinking they were smart. And then you have like 2019, you could use these. And I think that anything else, if you take out these outliners, might be more significant, but just let's blend it all together and take a look at what they give us. What I was most taken back by, what I thought was most interesting was it was constant. It was from the week 2 weeks, 1 month, 2, 3, 6, 12. It was constantly up. So you have one blend here where it got really weird on the 6 month for 53%. But overall, what did you have here? 71%, 71%. It was like clockwork. And then you had this one anomaly for between 3 to 6 months. I'm not really sure what happened in there. And we could go through that and take a look at it, but it fell off there. But overall, at the end, 12 months, 71%, and your median was 12%, and your mean was 15. And then you could look at your average max loss, which they average their losses together, and then the average max gain. And I just thought that that was pretty insightful. I don't know really what happened here, but obviously something transpired during that particular period of time. And it's not even the same month. I kept looking at the month to see if there was something specific about it, but it was not. It's just that time for whatever reason, and it throws it off. But I do think that this data is significant, and I do think it's worth our time. Now, I thought this was pretty fascinating. You would think the consistency of what happens when this XLK fires. So when this XLK fires, they take all of these data points, including the S&P, and they say, and this is Sediment Trader did this work, and they say, okay, well, what does that tell us? It tells us what sectors are up or down during that period of time. And they're all over the place, right? They're going to just be all over the place. And again, that 6 month area seems between 3 to 6 seems to be the laggard. And then from that window on, it starts to kick in again. And I'm not sure why that quarter flip does it, but it does. It's worth noting. But this is from the date that it fired to where you're at. I thought this was pretty interesting. 91% of the time when this happens, a year later, the S&P's up. Now, they don't get into the specifics of how much. We could go through and calculate it ourselves. But 100% of the time that fires, consumer discretionary is up, which is retail. Which is kind of interesting again, because look at what Buffett's doing and what Ackman are doing and how they're stepping in place right now. How they're buying Nike, how they're buying these names, right? How they're buying Ulta. All the shakeups that we've seen with Starbucks and all these consumer discretionary companies are happening right around the same time that this triggered. And this triggered, obviously, after the fact of this, but I do find the timing too much of a coincidence. Also, I thought that healthcare is up 100% of the time that this trigger happens. Just odd. 17 data points, I think it's worth noting. And the research piece over-highlighted this, which I thought was I like how they did it, so I figured I'd share it. So they take the VXN, and the VXN is obviously the NASDAQ 100. Now, once they take that, it triggered a what? A buy signal. So you have buy, 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 and we can see those signals right here. But what they do is really fascinating because they take the NASDAQ 100 volatility index range rank. They take 81 days and they rank those days on a percentage of where you're at. So in other words, see where the VXN is here, and you would say, oh, that's not too bad. Well, that's a 99th percentile of what the last 84 days were. That's pretty fascinating to me because it makes a lot of sense to look at that. If you're here and then all of a sudden 50 days later you're back to here, you're not going to be in the 99th percentile. So the fact that they're taking those 84 days and saying, okay, what percentile are you in over the past 84 days? And I'm not sure why they do 84 days. Maybe because of a calendar or for some reason. I'm not really sure, but they do. And if you know why they do 84 days, just comment below because it's not a quarter and it wouldn't just be the weekends, right? So I'm kind of curious why they would do 84 days. You're always welcome to comment below if you know why. I'm always willing to learn something. But if you look at that and you look at these levels every single time that you pop over that, right, you're getting to this level and it's signaling this little buy signal. And it doesn't matter whether you're here or here, it's still the 99% because you're going back 84 days. And here we are. And then they are the signals. And obviously that is November, which is when she came out and said, we're not going to raise rates. And this is when we sold back down and things were going to get really bad. And then we hit new highs. And this is when things sold down again. And, here we are again. But if you look at this data and what I really like about what they do, and again, I have no affiliation with them. But if you're trying to look strategically on what does this mean, going back and looking at backdated data and then extrapolating it forward is really the best way that you can look at this stuff. And what they're saying in regards to the NASDAQ 100, and I see this through the breadth, and I'll show you the breadth from what I'm looking at in a second here, but this is what they come up with, and they say 86% of the time that this happens, you are looking at a roughly, the median's 20% on the NDX 100 and 16.9, 86% of the time it's positive. And again, look at these numbers on the percentage basis. And I don't know what happens between, in here that we fall off like that, but I do find it neat. What does all this do for you? Like, what do you really do with this? Someone commented the other day when I show the day trades, because a lot of people ask to see day trades or swing trades, things like that. And when I show them, you can extrapolate those day trades out and you can make them swing trades or long-term trades if you're looking at the technical piece. But what does this do for you? Well, this should get you to think strategically, right? Tactically is going to be your short term, and then strategically, I would think of it more long term, like, okay, well, where's the money going over the long term? And to me, we thought we were going into that more the IWM names, and I think you will as interest rates come down, especially yield sensitive names. But really what we're seeing is we're going right back into high beta. You're getting a high beta bull market, and that's where the money just poured into. We can say anything we want, but this is where it went. Technology experienced a significant correction, leaving investors questioning its leadership status. That's an understatement. The following pullback surge triggered a breadth thrust above their 10-day average, cycled less than 10% to 50 or 90 in 5 sessions. Comparable thrusts, bullish absolute relative trend scores, outstanding returns, consistency for the group. Should history rhyme, technology should outpace the broader markets. So what this is telling you, and what do you do with the data points that we just went over? Understand that tech is going to be dominant and tech is going to be leadership. And you can see this also not only in this breadth thrust, but let's take a look at breadth just in the market, because I think when people are looking at this, they're not getting how significant the move and bounce was. Now, we've looked at this from the standpoint of one specific sector and then how that overlaid with the NASDAQ, but I don't think that it really does it justice what happened. So I want to go through the NASDAQ and I want to go through the New York Stock Exchange so you can see what actually happened here. And then I'm going to show you some research that came out on Friday that's really going to signify just how crazy this was. And there's no other way to say it. So I wanted to show you the advanced decline line right here. So if we look at this level right where you're at this level where you're basically at 0.4 right down here at this level, which is pretty significantly low. And this is just your advancers by your decliners. And I'm just going to mark that off right there so that you can see where you're at. And you can see how you've popped up and how it's getting stronger and stronger over time. Now, this is where it gets super interesting, because if you take this specific time period, and what we'll do is we're just going to drop a line very clearly. You can see where we're at from right here, but we're just going to go back to, let's just go to the end of May and just drop that there. And we can see that we're now higher than where we once were. But let's color this in, this advanced decline. So look at the breadth that was going on here leading up to this event, and then the breakout of breadth into here. And then look at how your movement in here was just stagnant. And what we're seeing once again is just this is just the New York Composite. But let's look at that for a second. All right. After this event, look what happened. And the reason for this is the majority of people were wrong. Now you're going to find people on the internet, they're going to tell you that they knew that this was going to happen. And of course they did. But here's the thing about this. You would have had to predict that PPI, CPI, retail sales were going to be good, that the US-Japan situation was going to remedy itself, and then you also had to predict that there wasn't going to be a war. So if you were able to do that, kudos to you. 99.9% of us are never going to be able to do that because we live in the world of reality. So what we have to do is we have to look at what is actually transpired and trade what's in front of us, as I like to say. What's in front of us is that as things progressed, we went from hard landing to soft landing again. And a very clear soft landing that's actually showing a recovery that's about to lead into an expansion. And I'll show you that in a little bit here, but I want you to get this. So we actually, after this, not only did we go back up, the breadth got better than it was. And I think that's a very important distinction that's being lost on people. Take a look on the NASDAQ. And we're seeing something similar there, but we'll do the same thing. We'll just take a demarcation line and we'll drop it. It doesn't really matter, but we'll take this leveling off period. And what we're going to look at once again is just, okay, when we were up here and we see the breadth of where we were at, we could see that drop. We can see how we're coming across. So you have that sense of where this was, right? And how tight that was. And you really weren't broadening out. And then you could see our drop. And then from our drop, if we just take this area as well and lift up, look at the advanced decline line and how much higher it is than that area. Look how you're not even up to that area yet and the breadth is better. So a lot of people are going to look at this and say, well, we're not going to go back all the way back up. Well, the breadth of the market is actually stronger here than it was here. It's actually stronger here than it was really here. So this is something that I think a lot of people are not understanding, how strong the market is and how much money has come into the market. And I'm going to show you this through some research in a second here. It doesn't mean that you're just going to go all the way up, but you have to understand that you're broadening out. You're not just lifting up. You're just not a technical bounce, right? So we could say that the unwinding of the US dollar and yen trade caused this. This was a technical bounce, which clearly the unwinding, when people say, I don't know what a technical bounce is, I can explain it to you. A technical bounce is when you have to unwind a trade completely. there's no justification for where it will go. It's just technical. You need to get out, period. So again, for those that don't remember what happened here, you have the US dollar yen trade where they would short the yen, and then after they short the yen, they go long the dollar, and then they buy denominations from the dollar of either equities or treasuries, and then when they raise rates, so you have that spread right there that you're booking, and then you're buying that with this, and then when they raise rates, that spread lowers, and that causes you to have to unwind the asset or the debt instrument. And then it happened so fast. That's what happened when we saw Japan implode, and that's what caused that. Hence the words technical. It was not like you came out that day and there was a fundamental reason for this. And then as time went on, we had the weight of, quote, the hard landing, the scare of that. And you can actually quantify that, and we're going to do that in a moment here. But really important to get what did this. When you say technical, that's why people are saying the words technical, because it was. But then you also had all the issues that led to this, and those issues have been abated, at least for the time being. Now, in front of us is the NASDAQ new highs, new lows, and obviously as you're dropping, you're going to have way more new highs up here than you're going to here because you were at highs. I mean, that's not rocket science, but I think it's important to note the new lows, and then how you're putting less and less new lows in, obviously, as you're going up, but you're also putting in new highs. So this is just steadily increased. You have a little bit of a drop on Friday at the time recording this, but you are making new highs on some names, and there are no more new lows. So again, not only do you have the advanced declining going up, but you have the new highs rising, and you have the new lows dropping. As a matter of fact, if you look at the 52-week highs on the NASDAQ, what you're seeing here is that this is where you bottomed out as far as names that were hitting new highs on that day from the NASDAQ. And you've done nothing but have new names all week long since this transpired of hitting new highs, 52-week highs. And then at the same time, you can just see here, MALQ is the exact opposite. And this is new lows. And you can just see nothing but new lows. So advanced declining, new highs, new lows. And on top of that, 52-week highs, 52 lows. No matter how you want to look at this market, it's broadening out and getting healthier. Now, I wanted to show this because I know a lot of people are going to say, well, we just rallied and this is why. I think you need to understand how crazy this got and how much compiled all at once. And it wasn't just the US, it was everywhere. So this is a piece by Ned Davis, and I think they did a really good job with this. And what this shows you is this just shows the world. And what it's going to do is just break it down by growth and value. And you always kind of want to watch what's going on in the world with the world indexes because it just tells you what to expect. This shows a rolling one-year correlation between the MSCI, ACWI, and the growth and value. So in other words, what it's telling you is what happens to the world indexes here if growth is leading value. So as long as growth is leading value, you'll see me do this with VUG and VTV for the S&P 500. Ned Davis does this with just the world. And this is exactly what they're doing. They're just showing you the correlation between the two. And this is the world right here. And you can see that as long as growth is leading, this is what you're going to get. And what they're showing is just the 200-day moving average right here. And I think it's important to get this, growth divided by value, and you hit that 200-day moving average and you held just like you did here and just like you have here in the past. And this obviously was January. You can see that here and you can see that in April. So it's not just us that had the shock, and you can see that through Argentina, Japan, any of the outstanding ETFs, which I would suggest that you take a look at and go and look because there's a lot there to learn from. But this is where we start. Growth versus value on the world index, and we can see how this is performing. And I think it's important to get that as we go forward. Now, I always look at trading as a rubber band. In other words, if you go too far one way, you're going to go too far the other way, and you usually have some kind of snapback. I wouldn't call it a boomerang, but I do feel that there is some kind of, if you pull back on a rubber band far enough, eventually it's just going to snap back in the other direction. Doesn't mean it's going to go as far, but it does mean that you're going to see some kind of snapback. So RO is risk on, RO is risk off. It'd be easier if they just had RON and ROF, but whatever, we're just going to keep going with it. Risk on, risk off right here, and they call it a diffusion index. And what you're looking at here again is the MSCI All World Index, and what you're going to see is this level, and you can just see how this is rocking and rolling. So what they're taking is they're taking the 50-day risk on, risk off, and they're showing you the difference between risk on and risk off on the 50-day moving average. Look at how low you are right here as far as that. That is just a trough level that you have very rarely been at, except if you start getting into when? November, And then you're right around that November, and we know what happened in November 2023 to the market. If we take a look here at the 200, risk on means, are they putting on risk? Risk off means, are they taking off risk? Think of it that way, because that's the easiest way to do it. And then you're going to come here and you're going to see a level on the 200-day between these two that you've never seen before. You certainly didn't see it back there. So we could actually make the argument, and it's a valid argument, that this pullback on the world stage on the 200-day by this diffusion index was actually more came off in fear between here and here than came off in general. And when you blend these together, you're not going to get the same statement, obviously, and you can see that already. But I think it's really important to get that. Here you are in November. Look at that level, and look at the level right here. You could say they're close enough that they're similar, but this one is a little lower. And then you go and go, well, geez, what happened November 1st? Here's the bottom line. People will say, well, you don't know that you're going to bounce back. 100% you don't know that. Here's what you do know. It really can't go any lower. In other words, they took so much risk off. And this is, if when I show these, sometimes I'll get comments, and I always love the comments, so please keep them coming. People will say, well, why are you showing this? You have so much risk off in the world that you're at a point where it's really hard to take any more risk off. And that's why the snapback and the broad-based rally was so fast. Everybody got out because you had so many things going on. And we went from soft landing to hard landing, which I'm going to show you so fast. Couple that with what was going on with Iran, couple that with what was going on with the US dollar and the yen trade, it just became a can of worms. Everyone's just like, just get me out and I'll just sort it out later. And it wasn't just in the US. It was all over the place. See, once you understand what the issue was, and this is my point, nobody knows that all of these issues are going to get resolved the way they got resolved. They're just not going to know that. Now, this is a graph, and it'll just explain it for people and show economic cycles, because most people don't realize that they need to look at the fundamentals and the technicals and the macro. We always look at it as what, who, when, right? So we look at the macro, and then we look at, which is the what, the who is the fundamentals, who's affected by the macro, and the technicals tell us when. And this is your tabletop giving us a stool. And we're just going to go with my childlike stool drawing for time's sake. Now, when you go through these, it tells you which one should come next based upon where you're going. That said, there are times when it gets very clear which way you're going. So where we're at now is we are not slowing down. We are not contracting. Okay, we are going through a period where we came in, and now we're going through a recovery leading to a possible expansion, all right? Because you can see the numbers are so hot, they were talking about we have to raise rates. So then they raise rates. Now we're getting a period of growth, and that growth is going so well that they're talking about what? Just leaving it alone. But then we were talking about what? Contraction. Okay, so see how you were flipping through these economic cycles? Are we going to go through contraction? Are we going to go through a recovery? Right now, you're going through what I would refer to as a recovery. To me, contraction is going to be when you have some real negative GDP kind of numbers. You're still growing. So whether you feel that you're in a recovery or expansion, it's really irrelevant. But you're certainly not contracting on any major level. And there was a chance that we were going to remember the economic cycles and how they move, right? And I think that this is really important. So I think you're still in a recovery, heading into an expansion, and then you'll hit a slowdown. That's how I see it. Now, it's not just me that sees it that way, but it's also Nomura who sees it that way. And what they're showing you here is 3 months, and they're saying over the next 3 months, which way are we headed? Okay. And this, I understand this is more strategic than me just pointing at charts and saying, look at this. But when you can understand all these points and you understand how people were looking at the world, when you start seeing the hard landing, soft landing percentages I'm about to show you, you'll start understanding why people were freaking out. So they take those 4 quadrants, and you can go back and look at that if you want. And what they're saying to you is currently we are in recovery, but the transition matrix shows that historically the second most likely move for the next 3-month forward window, besides maintaining recovery, is a move into full-blown expansion, which is growth up, inflation up. And so what it's showing you here is saying, okay, well, we're in recovery right now. What are the odds of where we're going while we're in a recovery? Well, we stay in recovery. Okay, where are the second odds? The second odds are going to take us to 31, and that's going to take you here, right? And I think that that's really important. So it's telling you that you're in recovery, and I do agree with that, but you're going into a level of expansion most likely. I've been saying this for some time, that you're going into an area where they're going to cut rates while we're growing. And it's starting to look more and more like that. And a matter of fact, the amount of money that came in the market based upon this recently, when you see it, is absolutely staggering. Now, some of this is a little advanced, so I'm going to just skip to the good parts. The fastest, largest magnitude resumption of short the vol rip by the spot dip, market mean reversion of the VIX spike that we've ever witnessed in the equity option space. In my opinion, it was almost a function of the market repricing a hard landing delta. So he's attributing it to hard landing. Now, why is saying that where we need to have all these cuts almost immediately? Remember when we had Jeremy on TV saying we need to cut 150 basis points by September 30th? And now what's so fascinating about this, going from 0 prior to non-farm payrolls. So we went from 6 to 0, then panicked at a 31-day peak on Monday last, spun off massive shift in the economic Fed policy distribution towards the left tail scenario. Left tail is going to be the hard landing, but now jobless, continuing claims, strong retail sales, more inflation, downside surprises, CPI, PPI. We have seen hard landing odds back to just 9%. Right? So this was a massive shift that happened in a very short period of time, and it happened because of the economic data that came out. Conversely, the panic capitulation put soft landing scenario Monday of last week, 3 cuts by year end, was at 80%. The panic capitulation out of prior consensus soft landing last week, which was at 80% prior to that non-farm payrolls. Okay, so you understand how we were leaning one way or another. We were at 80% towards a soft landing. And then what we saw that shift drastically before or after, rather, the non-farm payrolls. Now, I know that might be a little more esoteric, but just understand where we're going with this. When you're looking at this market and you're saying, well, we got whipsawed and I knew better, okay, everybody got whipsawed. Sure, we had short-term trades and sure we did really well. But when you look at this, the fact that no landing a month ago, there was a 5%. 3 months ago, you had a 50% chance of, quote, no landing. A soft landing went from 77%, dropped down to 37%. So we got cut more than in half. And then after that peak, rallied back to 65%. You have an uneven landing, and then you have a hard landing where a month ago you had no chance of, and then all of a sudden that hard landing went to 31%, and then that went to 9%. And what they're showing you here is we went from more than 6 cuts by year end. So at one point, while all this was going on, we had a 33% chance of 150 basis points in cuts before the end of the year. A 31% chance of doing that, and before all this nonsense started, it was 0. Okay? That's really important to get, all right? A month ago, when you look at this, you had a 77% chance of a soft landing, which was 1 to 3 cuts by year end. That got cut down to 37%. This is why the market moved the way it did and why it reacted and bounced back the way that it did. So this is the definition of whipsaw, so you understand. And this is why this probably can, people always say, well, what is this telling me? It's very difficult for me to see how this does not continue to some extent. And I'm just going to show you this. This is where we sold out. This is where you are now. Levered ETF weekly rebalance is 34 billion. You have more money pouring into this because they realized that everything that they thought could have gone wrong just went right. Meaning the war that was supposed to happen between Iran and that was supposed to elevate, all of a sudden that dropped down. The US dollar trade was supposed to be more of an issue. That's not an issue. PPI, CPI, retail sales, okay? And switching from the hard landing to the soft landing. So all this together, earnings, everything, putting it home in a ball of wax, everything that they thought was going to go wrong didn't go wrong. It all went right, which is kind of crazy, but it's exactly what happened. And this has to be on record the biggest shift that you've ever had really out there in levered ETFs. Now, this comment kind of made me laugh. By our estimates, we see levered ETF space 5-day rebalancing, the largest one-week buy flow in the history of our data set, 34, buying across these awful products in the past 5 years. Tell me how you feel about them. But it's very difficult to look at this and not think that there's got to be more behind this, or you just think that that's it and then they're just going to stop. I'm interested in your comments on this. But I think it was very important for me to say, this is what happened, this is how we got there, and understanding all the pieces and what led to it. A lot of people right now are feeling that they should have known better. And what I'm trying to show you, and if we got super into this and we started looking at the futures market and what happened there, Nobody caught this. People caught it and traded it and did exceptionally well on the trade side, but no one said we're going to fall apart and then we're just going to miraculously everybody's going to fix themselves. Nobody said that. So it is what it is. You trade it and you move forward. It provided some excellent trading opportunities, and I think it's providing a really good basis for going forward into the end of the year. Let's look at some charts. I want to walk through this trade because it's a really good learning example, and I keep getting a lot of comments to show more trades. These are short-term trades. I do want to do some long-term trades because I'm getting asked about it. This one was a really good teaching lesson, specifically for so many different reasons. But it's always day 2 where you're going to get the blow off, and I'll explain what I mean by that. So I'm going to leave the pre and the post in. Everyone's familiar with this name. You had really good earnings, apparently. I thought they were garbage, but what do I know? Stock exploded to the upside, and maybe I shouldn't complain since I did so well with the trade the day before and then the day after. But stock explodes to the upside, and while it's exploding, the next day everybody gets online, they see what name moved, and they always have day 2 of retail in these names. It's day 2 where you get these reversals. It's not always, but it's never really the first day. It's usually day 2 that you're going to start seeing like the last of the stragglers get in, the people that don't watch the market all the time. So you always want to watch that. You always want to watch after hours and see where those people are as well. So what I always tell people to do, there's a couple ways to do this. The first thing to do, and we came in, actually, a bunch of people came in long this. The first thing that you always do is you mark the previous peak of anything that does this. And then the next thing you do is look for the peak either pre or post market, and you mark that. That's the basics that you start with. Now I'm going to show you something. What you'll note is these become demarcation lines, and that's exactly what they became today. When you start to see the open, and I show you this live, you'll see it. It tries to get through that first, it can't. Tries to get through the second, it can't. Rejects, pops over, and you'll see this is exactly when we put the trade on. We go right here, we go long stock, long calls. And then from there, the trade's on, and we're scaling out on the way up. And you should be able to see some of this. Let me show you it this way too, so that you can see some of the timestamps. So this is us actually adding to the stock and the 35 calls where we paid 85 cents down here. And we're getting out of the rest of like the highest push we get out of some is like 270 or something like that. But you can see right there where we're adding the stock, and we're doing it on this bar. Like we're buying it in here. By the time I got filled, probably got filled more on that bar or that wick. By the time I actually got in the stock. But right there is where we're doing it. And we're watching these 2 levels. I'm not watching the 1 minute orb because I'm doing it right into resistance. And I don't want to do that and get stopped out. I want to get through my level and then be able to utilize that level as a stop. Then what we're doing from there is we're just constantly monitoring the trade. And that's really what you want to do. And you want to, as it's going up, all you're doing is you're pulling money out, right? So here, I'll show you this as well. So what I'm doing, and I'll show you this actually on the trading journal too. I think that'll be a better way to do this. Maybe I'll just show a portion of it like the stock. Because that's easier to see. But you can see that we're pulling stock out and options up as they're going in our favor. We're actually pulling them out. And then we just kind of get to the point with it as time goes on that we're just pulling more money out. And at some point, we did actually better on the calls then. The stop loss was moved to 100% because I think we were up like 230. So we probably were up like over 200% in them pretty quickly. But what happens here is I saw a reversal, and I'll get to that. But what this is showing you is that as we're going up, we're pulling money out. Same thing with the calls. We're pulling money out because we know that at some point these things always come home to roost, and it's Friday, so you know that you're going to have an issue. Then we see a reversal pattern. I'll show you that reversal pattern. And once we saw that, that was it. And I'll show you what that looked like here. And what I'll do is I'll show you the stock trade. We're going to go to the option trade too on the trading journal so you can see it. But it's important for me to show you the timestamps so that you can see this. Again, you have these 2 levels marked off, but when you see a reversal like this, you need to pay attention. See this reversal up here? So what you're going to first notice about it is this. You have 36.87. Then you have 36.82. Now, usually I want to see us get over that level, but we couldn't do that, right? We couldn't get over that level at all. So you see those numbers right here? And look what you're doing there on these numbers. Watch how exact these numbers are. Watch the close and opening bar of these numbers. Watch how exact they are. 36.78, 36.78. They are exact to the penny. The high here is 87. The high here, right? Can't get over that high, 82. So you're opening and closing right around the same price. Okay, very rare that something that's moving like this is going to do that. So if you're ever in something that has like a lot of momentum and you see something like that, it's going to give you kind of a, okay, I need to see how we're going to do there, right? Kind of move. Like not, if you can't even move pennies, like even look at these, you'll be moving pennies from bar to bar as this is going on, right? You can see it if you look at it up here. And you're just going to go flat, open to close. It does give you a little bit of a, okay, I might want to pay attention to this. Now, once that bar completely encapsulates this, and you'll see this live, once that happens, you know that you have a problem there. And once you see that problem, you've got to get out. I think you have to get out. This is a reversal. It's a bearish engulfing. I also will do a couple different things. I'll show you the other way to do it. Do you see the size of these bars and how small they are? Do you see how big these bars are? When the bars start getting to this size, you're getting to the point where you're getting a change in trend. You're getting that frothy behavior, and you can see how small these bars were and how orderly this was. And this is just every guy that's working from his desk at, talking to his bro, it's telling him he's got to buy this because, space phones. And then you get the reversal right here, and then that's pretty much it. You could, I'm sure you busted your 9 and everything else, and you could drop your VWAP right in here, and your VWAP's right aligned with that one, but it doesn't really matter to me, the VWAP on that bar. I'm more concerned about, am I going to break this VWAP? Am I going to break that VWAP from the peak? Are these people that were in at peak level and after hours, are they down or up? They're down. And then it starts dropping. Now, when that starts to happen, everybody is on one side of the boat, meaning everybody's buying. So the idea of puts, nobody even wants puts. So the puts become ridiculously cheap. And so what I do when I start to see this is I'm blowing out the trade. So I'm blowing it all out, put the stock break even, and I bought a bunch of the 30 puts for 40 cents. I was between yesterday and today, I was up considerably in this trade, stock and calls. So what I did was I just looked at it and said, from here to here, it's 40 cents. It's really absolutely nothing. For me to put this on and to spec this out. And if it did gap down, which they never halted this, which was kind of crazy. Let's say I did gap down, I'd have cheap puts to buy stock, which is really what I wanted to do if we gap down, because then I thought there'd be some kind of rally. That never happened. And then as it's dropping, all I'm doing is taking advantage of the drops. And while it's dropping, I'm just pulling money out over and over and over again. And again, I just want to go through this so that you can see it. As this is dropping, we're just trimming the puts down on the way down. Almost, I think it was 100%. And then they got to 2, and then we're like, okay, let's get out of some more. The undercut, and then by the time we got to here, we had these wicks. I'm trying to buy stock against it, and then I just didn't like the way the stock acted, and I closed the whole trade. You have to be, when you're trading these kind of high flyers, you really have to be really unemotional about it. You have to not go out there and say they're going to have the best product ever or the product is garbage. You kind of just have to look at it and go, okay, this is froth. What stage am I in? And let me explain what I mean when I say that. So these are peak levels, right? This is someone talking to his bros at night saying you got to get in. These are guys in the office the next day. Like no one on any institutional level is buying this thing up here. We know that, right? And you can always use the previous day VWAP, and you'll see some really key levels here, how you held here and how you held here for the rest of the day. So it does bode well for it going into Monday. But that said, when you held here, that's a pretty good sign. What we want to do is not be emotional about it. We want to look at these levels and we want to figure out how we can make money off of it. And that's exactly what we did. But you need to detach emotion from it. You don't want to take one side and be blinded, because that's going to keep you in the trade. That's going to be ego. You don't want the ego. What you want is the money. So you're doing the trade for as long as it works. And the first sign that it's not going to work, I don't need this, right? To stay in here, to go through this, to get that, right? In other words, I don't need the last $2, $3 up here on that trade. Get my line. So let's just say it pulled back and then went. I don't need this. If I can just pull this out and get out of the way, I'm fine. Just keep doing that over and over again. I don't want to go for this ride. And then this reversal allowed us to do that. So here, take a look at this. Watch this live. ASTS did it. You seem to be working off that level there. It looks to me like you're going to push there, and you have to use low of the day. Yep. So I added to that. We can go take a look at some of these options. The 35s make the most sense. 75, 80 cents. I got a bunch of those options. The 85s, I paid 85 cents for the 35s. I got a bunch of them, and I got a bunch of stock. Already up $1 on that whole trade. Already up in those calls. I'm not doing anything with it. I'm up 100% already. Sold a chunk of them, up 100%. I'm going to sell some of that stock too and just lock it in. Trimmed more calls. I paid 80 cents. I just sold some for 270 and change. wrong way. Trim stock, I don't like that bar at all. That's a complete reversal up there. 100% out of the calls of ASTS. Thank you very much for playing. The rest of the stock is at break even. Like, what if this thing gets smoked? I'm going to buy a bunch of the 30 puts for 40 cents, no stop. I'm just looking at it and saying, what if we get smoked here? Like, eventually the party's going to end. The easy money's been made. What if this thing goes to like 22 today or something stupid? For the amount of money I made on the trade, to go out there and throw a bunch of money, 30 puts, and just see what happens, who cares? Well, they exploded, 75 cents. I'm going to lock some of that in at 70 cents, leave the rest on. Basically, it's a free trade. I'm up 100% on those now, on those puts. Pulled out a little bit more. Still have well over half of those puts. Now it's red, 200% in those puts. I trimmed down to a third. There it is, $2. Up 400%, trimmed. Oh no, too much cheering. Trimmed down to a third, under a third. Why not just buy stock against it? I think you're gonna rip. Then I just have a free position all day. Yep, I'm in the stock. Now I have a free position in stock and it's paid for. I'm gonna just leave it on all day. I think I'm too early, Sold the stock. What are the options? 2. I think we're just gonna get out of the calls and call it a day with this thing. Trimmed more, down to 10%, out 100% of the trade. I'm out. I did it too early. It's fine. I'll come back to it. So I'm going to want some feedback on this. If you can put it down in the comments, and I will read it, and I'll tell you why. Click over here. Instead of me showing the same trade over and over again, what I'm interested in possibly doing is showing how other people that I work with are actually implementing this stuff so that they can use it. You can start seeing how they're getting better instead of this kind of, look at me. The reason I'm showing this is I get asked to show it, and I think it's a really good time to show it. This started with like $1.68, I think, and I think this is really important to get. There are thousands of trades in here. This account is run and gun. It is super aggressive, and I am being very aggressive day trading this account. I'm showing this, and I'm going to walk through step by step on how I did that ASTS trade, and then I'm going to show you signs of how you can use that for swing trades as well. I think I'm better off doing that than just walking through the same trade again. Your comments are appreciated, but I think I also want to show people on how they're implementing these strategies versus this kind of like, look at me. Here's the trade expectancy per trade. So you always want to know these things, always. This is TradeZilla. I think they do a great job. I really don't care what you do. That which gets measured gets results. This is a game changer. When you see it on paper, it's a game changer. And then you have your win ratio here. And then you have your average win rate. Okay, this is where I'm at year to date, January, August 17th. This is one account. This is not how I trade all my accounts. This is run and gun. That's my win rate. Okay, this is someone that's been doing it 2.5 decades at this point. And, I started when I was 23 years old. So I just get that, okay? This idea that you're going to come in 70, 80%. Are you going to have strings like that? Yeah, there's strings in here where I can show you a week where I'm up 70, 80% win rate or, but there are times when you have to realize you're going to revert to some kind of mean. And therefore, when you understand that, that's why you have to use stop. So I want to go through this, and I really want to ask your opinion about it. But I think I'd rather show other people and how they're implementing these strategies. But your comments are appreciated on this, and please comment below. I'd rather spend the time walking through exactly how I did this trade, and I think that there's more value in that for everybody. So let's get to it. So what we're going to do here is I'm going to walk through the parts of this trade, and then I'm going to show you how to implement this, not just on day trades, but how you can implement this strategy. Real simple on a swing trade. It's very, very simple. But what I want to do is just give you the key areas. So, and when we did this trade, and again, this was just a very simple day trade, the first thing I want to know is I want to know where everybody is. So I want the VWAP for the day, and I want it left in because this was the crazy day, and I want to understand where everybody is. That's my first demarcation line. You'll note I have no volume in here. I don't need the volume. The volume's crazy. We know the volume's crazy. You might want it later in the day, and I can do that in another video, but you want to see spikes in volume later in the day. For example, one of the people in the room that wanted to trade this, I showed them this in like midday because you started to see like these spikes. And let me clean this off real quick. I'll show you this just concept wise really quickly so that you can see it. And then we'll get to there. What you'll see is you see this, that VWAP level I just mentioned. What are you saying here? Okay. And then what happens right here, right? See that spike right there above all our levels? Okay. So you're starting to see volume start really coming in there, right? They become areas of interest for sure. I'm not saying that they're not, but in here, do I really need the volume? Is it really adding anything to me? When I trade off the open in the morning, I want the least amount of crap on my chart, and that's the technical term for it. Because all I want to do is just be able to process information extremely fast and act extremely fast. And one of the things people say in the community all the time is that, when I'm wrong, I get out of the way fast, and that's true. Hence, you have to be. But what you want to do is you want to take the peak. Again, it's not going to matter if this is your 1 minute chart, 5 minute chart, daily chart, swing trading. And I got a lot of comments from guys that watch these videos. They're like, look, man, I got a full-time job. I can't be whacking around 1 minute charts with you. I got it. I get it. But what I want to show you is when you get to these areas of interest, the parts of the trade that you have to have out in your head already before it begins, there are 4 parts to this trade that you already have to figure out before it's even on. The first thing you have to figure out is where are you entering this trade at? For me, it was I'm kind of wedged in here, flips over, and I get involved. All right, that's the very first part. You have to figure out your entry. Then you have to go, okay, where am I wrong? So I always set my stops below where I'm busted. So for me, under here, you could use under here, and I use closes. Specifically, I use closes on this kind of like wacky stuff that is highly speculative. Don't get mad at me to the guys that like space phones, but it's speculative. We know that. So what we want to do is we want to utilize this. Now, when I say utilize this, I want to close, and you'll see even how we reverse this trade later, but that's the first part of this. You want to know where you're entering, and you want to know where you're getting out. Then you want to know where you're scaling out. Some people are all or none, and that's fine. That's up to you. I'm never all or none with these trades because when the party ends, it ends. I use a system that's very simple called positive slippage. I want to get out while the getting's good. I don't care if it's a 1 minute chart, a 1 week chart. There are different processes that I use for different kinds of trades. But if I want to get out while the getting's good, I have to be getting out while everybody wants in. Right? You have to think about it as a door. If everyone's trying to get through the door at the same time, you're going to have a problem. So if everyone's trying to get into the party, right, you want to just sell them tickets to get into the party, right? If everyone's trying to get out of the party, you want to make sure you're the first person out the door. It's like leaving a ballpark after a game. Yeah, I'm one of those guys that leaves early. So if you see this, you're selling into it. So you want to know 1, where are you getting in? 2, where are you getting out? 3, where am I scaling? The easiest way to look at this is to look for demarcation lines. And those demarcation lines could be previous highs where you rejected. I usually scale right into them. I go on the assumption that they're going to fail. So I'm scaling out, boop. And what that allows me to do, I don't usually make that noise, but what that allows me to do is then I can just go, okay, well, my stop, if I'm going to move my stop up or down here, it gives me breathing room so that here when I'm cheering, when it does this, I'm not panicked. And then it sets up again, pops over. I'm selling into this, comes back down, retests, pops over. I'm selling into this or I'm selling here. Then when I get a reversal, when I'm down to like a partial, like less than half, at that point, when I'm down to less than half, I guess this is important, I'm at a point now where it's trailing. So by the time I'm down to 50%, it's trailing. And then on this particular case, once it flipped here, we went short. And that's a classic reversal. And everybody should know that. That's a bearish engulfing, and we did that before. But those 4 parts can be used on any trade. Now, another thing that you could use, and I'm going to clean this off, on any trade is just understand where the players are. When you understand where the players are, it makes life a lot easier, and I'll explain. So in other words, you have these moving averages that are here, and VWAP, we'll call them VWAP, even though they are averages and they do move. People get confused. So these are VWAPs and these support and resistance lines. So let's click that off. So there are the 4 steps I would use. The second thing that I would use is this. I would go here, and I would start using just an anchored, very simple, but it's a anchored volume profile. And you start when it got wacky. And what you're looking for is point of control. These are value levels. We can get into that another time, but I just want to know point of control. Where is everybody? Where is the most amount of stock bought at one time? Point of control is very different than volume weighted average price, because this is where everybody did the trade, right? And then you look at it and go, oh, the most people own stock here, and then VWAP is the average of all this. So if I can get over this, that's good. But see how you get to that and you reject, tries, bounces, tries, right? That can be very different. Point of control can be very different. Now let's look at this on a possible swing trade and how you would do this. Now these strategies are really great when you have extreme moves. And that's when you really should be using VWAP. If you use VWAP all the time, I like to say you're going to VWAP all over yourself. But let's take something like Apple and say, I really want to be in Apple, which has just been an absolute monster and probably will continue to be. But we'll get into that another time. I want areas of interest. The very first area of interest is VWAP is down here. Right? So this is where we have what we would refer to as a swing low. And then we could also argue that this was a previous swing low. See how you undercut that right there? And then that becomes the swing low. And then you can see, what did you do here? You held right there. All right. I don't want to make this too long. It's already too long, this video. But what you're seeing right here is, see how you're held in here? Let's just say that that's not your groove. My groove is, I want to be in where they are peaked out. So here's a peak. So I would drop a line there. See how we fought that area right there? That becomes a demarcation line to me, peaks. I do want to see support. Do I have support? Yeah. Where do I want to get in? Peaks. So when I get over areas like that on peaks, and then you use this. So you can use this specifically, what I'm showing, for swing trading. Then what you do with this is you drop this down. So this one becomes irrelevant. I take things out of the way to me that are irrelevant. And you can see this pinch. We call that a VWAP pinch. Drop this down, go here on a regular chart. And what you're going to see is exactly that. Let me show you. See here and how you battled in here? So people will be like, oh, I should have bought this day. Well, you don't know that. And then people don't understand why it sold down. Why did you sell down so hard there? And then you understand that the people that own this at the peak level, they're getting out. You always want to know, not sometimes, always where the peak people are. You can see how you're acting right in here. Test that area, and then this becomes what? Support, pardon the voice. Now, the other thing you can do with this that I find extremely helpful is to drop a profile on there. And I'll show you this because, as someone likes to say, it becomes absolutely glaring. I don't care if you're doing a 5, I don't care if you're doing an hour. It doesn't really matter. What you do is, let's fix this. What you're doing here is you're just taking that peak and you're just dropping a line from that peak. Now, what you're going to see here is from that peak right there on that chart, what do you have? You are above point of control right there. So again, if you are to take a look at this, you are above that point of control. And all of a sudden, that starts to make it a little clearer why this is pushing. All this without moving averages, volume, or anything. All you're doing is looking for demarcation lines, places of interest, and now you have it. And I think this is really important. I'll give you one more. And the purpose of this is, then again, all you have to do is use this with what? All you have to do is just use this. The day trading strategies, very similar to this. If I mark that peak right here on the anchored VWAP and I drill into this right here, look at the battleground. Rejects, rides it. And always when you're under, not sometimes, always when you're under fighting these, you want to pay attention. Next day, boom, that Thursday, test never looks back. And if we take the same strategy right here from that peak and we just drop this, let's go to here and do it. I'm not going to have time to edit this because this is actually going to go over a little bit. And all of a sudden, I can see where point of control is. And look at how you're fighting right there. And again, it will not matter if you're overlaying this on an hourly, on a 5-minute, on a daily, you're going to get the same level. And all you're doing is watching that area and seeing how you react to it. I think doing this is way more helpful than me just pointing and saying, look at this trade. But I also think it'd be helpful to watch how I work with people and they actually do these trades and implement it in their strategy. So I'm looking forward to your comments on this. Also, I set up an Instagram account, a personal one. I never really got into it before. I'm going to start doing lives there, impromptu. So if that's something that's interesting to you about the market, you're probably going to just want to go into the description and find the link and follow me there. Because it's just easy to click that button on and off, it looks like, and just go live if I want to for a couple minutes. That's it. As for next week, you have the biggest event out there, probably of what's left for the year, which is going to be the Jackson Hole speech. You're going to want to pay attention to this. A lot of economists are going to want to watch this as well. They're also going to make comments and projections about whether or not interest rates are going to go down, whether they're going to go up. Every single word that he says is parsed. If you take a look at this event, you will note that these are some of the wildest days out there. So you're going to want to pay attention to Jackson Hole. That's it.